Hi, this is Dan Encell, Prudential California Realty. Today is Monday, June 14th. Here's what's happening in real estate headlines. First one, application for mortgages tumble. Not unexpected. This is the lowest level of applications for loans that they've had in the past 13 years, but it's not unexpected because there was a sort of a glut of activity right before the federal tax credits expired there. So we're down about 35% compared to 4 weeks ago when people were scrambling there. But again, it's a headline that's not unexpected. Everyone was anticipating that the summer months were going to be relatively quiet for residential real estate as the amount of buyers has to sort of regroup a little bit after there was a rush of activity to get under the wire for the federal tax credits. Next one, May foreclosure rate steadies as banks hold back. Says that the foreclosure crisis seems to be leveling off, that the amount of new foreclosures is about the same as it was a year ago out there. What they're not really saying directly in the headline is that the banks are artificially keeping that number low by holding back on starting the process with people. They are letting delinquent homeowners stay in their properties longer. So it's really hard to track whether it's really getting better or if it's just an accounting issue there. So we have to sort of wait and see how much, of these people that they're letting stay longer actually end up in the process and get foreclosed on, or can use this extra time to get back on their feet there. So definitely an unknown there. The big variable to whether or not these people that are right on the cusp there fall into the foreclosure and end up, all the way through the process, or they're able to get back on their feet, really tends to hinge on jobs. And that's what the next headline is that U.S. housing rebound depends on jobs. Could take years. Recent report by the Harvard University's Joint Center for Housing Studies said that the employment is going to be the big key to whether or not the market, is able to reach bottom, maintain, and lift itself back out of there. No new jobs, no new home buyers. Loss of existing jobs is going to force people into selling there. So jobs is going to be key, both job retention and job creation. Job retention to keep it from getting worse, job creation to actually help get it better. So again, that's something that have to wait and see how the job front does there, but that seems to be at this stage the crucial part to the real estate market there. Initially the market was brought down by bad loans. Bad loans, toxic loans, loans of people who could never actually repay them. Those eventually came due and that caused a crash. That wave is done. The new wave, though, is really based on unemployment. People lost their jobs. They were a good credit risk when they got the loan. They're no longer a good credit risk because they have no income. They can't afford their house anymore. So that's what's really, determining the direction of the market from here on out. The good news out there right now in the market is mortgage rates remain historically low. 30-year fixed rates just a little over 4.7 for conforming loans. 15-year fixed under 4.2 for conforming loans there. In the almost 20 years that they've been tracking 15-year fixed loans, this is the lowest they have ever been. So that's the one saving grace out there for the real estate market is low interest rates, available money that's very cheap. So that's what's definitely keeping us afloat out there right now. So hopefully that'll continue to stay low. Almost has to. Hopefully there'll be some more job creation which will help start getting buyers back on their feet and able to start absorbing more and more of the inventory out there. So that's what's going on right now in residential real estate, and have a great week.